What is up, YouTuber Nation, Cryptocurrency Nation, all you guys on the social medias? It's your boy Brivial. Welcome to the show. You know what we talk about. We talk about the cryptocurrency market, the Forex market, and we talk about the US dollar and conflicts around the world to affect the economy and what we invest in. So the CPI news came out today about inflation, so I'll let Yahoo News talk about it really quick.
We did get some reaction from the White House today on the back of that data, with the president saying in part, well, today is a reminder that Americans' budgets are being stretched in ways that create real stress at the kitchen table. There are also signs that we will make it through this challenge. He goes on to say, well, today's report is elevated. Forecasters continue to project inflation easing substantially by the end of 2022. Let's bring in our first guest for the hour. We've got Matthew Lazzetti. He's Deutsche Bank Securities Chief U.S. Economist. Matthew, let me just have you respond to that. What we heard from the president today to say, look, we know the number is bad, but it's going to get better this year.
Sure. First, thanks so much for having me. I think that has been the base case. But I think what is worrying from the inflation data this morning was not only that it missed to the upside, but it was the nature of that miss. We had new vehicles prices flat, and so that was expected goods prices kind of coming down from the very lofty levels. We also had a negative print in terms of lodging away, so hotel prices were negatively impacted due to Omicron. But the worrying development here is rent inflation. It was the highest month-on-month since 1992. We saw healthcare services inflation accelerating. And so these persistent items that I think the Fed will be very focused on pretend for upside inflation risks as we go throughout the year. So no doubt, I think we will be coming down on a year-over-year basis. The question is to what level? And I think it's going to be a much higher level than forecasters have anticipated and the Fed has anticipated as of late.
Hey, Matthew, Brian Chung here. Great to have you on the program. Now, you've just got a note hot off the presses in reaction to the CPI, noting that this could be a doubling down on policy tightening, obviously referring to the Fed's next meeting in mid-March. A lot of chatter about the possibility of a 50 basis point rate hike in one move, which hasn't happened since 2000. Seems like that would be pretty aggressive and might signal perhaps a little bit of market uncertainty in the future. What do you see as the Fed's response to this?
Yeah, so far from Fed officials, we've heard that they're keeping all options on the table. They're not discounting the possibility of moving by 50 basis points or moving by meeting to meeting, but they have kind of guided away from 50 basis points rate hikes. We heard it from Cleveland Fed President Loretta Mester. We also heard it from Raphael Bostic yesterday. But they've also, I think, indicated that they're going to be focused on, are we seeing evidence that inflation pressures are in fact dissipating as they anticipated? I think this morning's data certainly does not provide that evidence. And then it also provides evidence beyond the near term that this is a bigger picture problem. It is a broader problem. It has migrated into services. And those prices are going to remain more elevated for longer, causing the Fed some issues. And so I think you have a Federal Reserve that is currently at zero. It's adding to their portfolio through March, despite the fact that CPI inflation just printed 7.5% and the unemployment rate is 4%. The market has moved to price it at roughly 50-50 probability. And I don't think that the Fed will want to surprise in a dovish direction at the moment, given where inflation is. So we do anticipate that at this point, the Fed actually does raise rates by 50 basis points in March.
What is the case for the Fed still adding to their portfolio? We're talking about 40-year highs here.
There's no fundamental case, to be sure, to be adding to accommodation at this moment. I think when Chair Powell has been asked about this in the past, it has been a sense of not wanting to surprise the market. So winding down QE relatively gradually over time, guiding in that direction. And then he thought that opened up enough opportunity to be able to respond to upside risk to inflation. And I think, they will end QE in March. But I think what we're seeing in the inflation data, what we saw from the jobs report on Friday, both the resiliency of the labor market to Omicron, but also the very significant acceleration of wages, tells them that they just need to get moving quicker. And so we see the 50 basis point move in March. We see 175 basis points of Fed funds tightening throughout the course of this year, along with the quantitative tightening or the drawdown in their balance sheet that we anticipate. It is a meaningful shock, we think, to financial conditions, to monetary conditions. And I think it does raise some questions about, can growth remain resilient as the Fed fights inflation as we get out into 2023 and 2024?
Okay, I want to drill down on this more because it seems like the consensus might be changing here. But to call for a 50 basis point hike in March is indeed an interesting call here. would that lead to volatile mispricing? And is that something the Fed wants to do here? Not quite on the level of a Volcker shock, but doing so would really kind of make markets, and not just in the bond markets, I mean, broad portfolio positioning would shift pretty dramatically if the Fed did that, no, right? Because the spectrum right now is very wide in terms of people calling for 3 to 7 to 8 rate hikes this year. If the Fed goes by 50 basis points, that goes all the way to one direction. Could that really mess things up and actually risk perhaps a tightening of financial conditions so dramatic that it might actually induce a recession?
So I think that has been the key reason to not go down this route of 50 basis points, because once you open up that box, you're not going to be able to control market expectations for where the Fed funds rate goes from there. And so I think as of up until today in this inflation print, that was a very compelling reason for the Fed to not go 50 basis points. To me, the recent data is signaling something that is very different. It's a broadening out of inflation pressures. It's an acceleration in those components that you should be worried about. And so the risks, I think, have shifted from not wanting to kind of lose control of the narrative about being behind the curve and being able to control market expectations to you actually need to tighten financial conditions. You need to reset policy in a better way. And you do not want to, I think, surprise in a dovish direction at this moment.
See, guys, so the Fed is in a tight spot right here. They printed a lot of money. They bought a lot of stocks. So their balance sheet is at $9 trillion. And if they tighten rates, which bringing up the rates from 0.25 to 50 basis points would be to 0.5, it's going to collapse the market. That's not even 1%. So they are in a very, very tight spot right now, and they have to stop inflation because that will just dramatically kill the economy. Imagine everything around you go up in prices to 50% more. And we are starting to see companies saying that they're not going to take in the extra cost. They're going to move it to the consumer. So if Jay Powell does not get his hand on inflation right now, Mr. Biden is going to be pretty angry. I expect Biden already had him in his office because Biden wants to get elected next year. So I'm pretty sure Biden has talked to Jay Powell and said, hey, we have to get inflation down and do what you have to do. So if Jerome Powell raises the basis points to 50 and he says he's going to have 3 rate hikes this year, and JP Morgan, Wells Fargo, other banks are saying he's going to have to hike it 4 to 5 times this year because they are behind the curve. The curve is at 7.6 for CPI, and we're at 0.25. So we're way behind the curve to catch inflation. So if he has to raise it 4 times, where are we going to get to? We need to get to 5%. And imagine if we're at 5% interest rate from the Federal Reserve. That means your house, is going to go down in price because people are not going to be able to pay the interest rate of more than 5%. Remember, when you go buy a house, guys, the bank goes to the Federal Reserve and say, hey, this guy wants to buy a house. Let me get the money at a lower rate and we're going to charge you a higher rate. So if the interest rate is at 5, they need to at least get it to 5. Your interest rates are probably going to be around 7 to 8% on buying property. And that is unheard of since the 70s and 80s, guys, when inflation was spiked really high. Of course, the stock market is going to fall. As soon as he raise rates a little bit, the market is going to fall because these guys, the hedge funds, know what's going on, guys. They all know what's going on. And the US dollar is going to get stronger. And everybody who has debt is going to have to pay a little bit more outside of the country. So when the CPI news came out today, the dollar rose, as I was talking about. the euro against the US dollar, you see it began to fall, because the dollar is rising up, and the US pound began to fall because the US dollar went up. With Bitcoin, this is kind of unique. I'm gonna go to the hour. Okay, so when they say inflation goes up, Bitcoin is supposed to be a hedge toward inflation. Bitcoin, a lot of people bought Bitcoin on that news and it flew up, and then it continued to fall right after. And the reason why is because the stock market fell, guys. Look at the Dow Jones. The US 30 just completely slammed down. Look at the NASDAQ 100 slam down. Look at the S&P 500 slam down, because these hedge funds know what's going on. I know what's going on. They know what's going on. Anytime you see CPI at a higher rate, that high, we haven't been at these rates since the 80s. That means the US Fed is going to have to start to taper and take it a lot serious. So I'm not a financial advisor, guys, but I was speaking to some traders in a room with me, and I was talking about this maybe a month ago. I said, people have no idea what's about to happen. Don't listen to these gurus about this fake pump right here from Bitcoin right here, this little fake little pump. Let's bring it out. After, some investors came in and bought this up, and guy from Barstool came in and spent millions of dollars buying this up. Don't listen to that. You have to listen to the Fed. And what I was talking to these traders, I was saying, all these pension funds, they're going to get killed. People who have a 401k, you guys are going to get killed this year, because the Fed is going to have to raise rates higher, and these hedge funds are going to take profits at the beginning of the year, guys. Let me go to the beginning of the year. It already started. This is the beginning of the year. It started. 2022, I warned you guys. I said it's going to start. And now we had a double top. Push back down. We're going to continue to push down. Look at the NASDAQ 100. At the beginning of the year, guys, I told you what was going to happen. And now we're at a double top again. Another thing we need to worry about, guys. Russia, Ukraine. Russia is on the border of Ukraine right now because he doesn't want Ukraine to be part of NATO, and the US is part of NATO. So we just started to send troops over there because we don't want Russia to take over Ukraine, because they have a lot of resources, natural gas, oil, and those natural resources are sent to Europe and those countries from NATO. We already see gasoline at close to $5 a barrel in some places. If Russia takes over the Ukraine, gasoline is going to go up further, and natural gas is going to go up further, because they're going to control all the resources, majority of those resources in that region. They control a large amount in Russia already, but they're going to control a lot more if they grab Ukraine. And that's going to add on to inflation. And if we get into a war, that's just going to collapse what we have over here in the stock market. Things you need to worry about, guys. So let's get into the cryptocurrency news. Binance, they bought 200 million stake into Forbes. These guys just bought CoinMarketCap for millions and millions of dollars. Now they're buying into Forbes. And let me give you the story with Binance. So Binance moved to a country where the regulations were just very, very mild. And they said, we want freedom for our traders. And then the governments for those traders shut their accounts down. Say, hey, Binance, you gotta come to our regulations for you guys to have access to our people to trade. And Binance got kicked out of a lot of countries. It's crazy. That's why we have Binance.com, BinanceUSA.com, because they had to follow the regulations of certain countries. Now, the owner of Binance is trying to make a long move. First, he bought CoinMarketCap to control what people see as the top coins. Now he's into Forbes, so he can have access for these people to see what coins are on Binance or what's on the BNB second layer. So he's making his moves, and I think he's doing the right thing. Instead of trying to fight these countries, I think he's making the long-term moves to be able to generate wealth with advertisement. Great way to move in. Also on news, the U.S. government arrested this couple because these guys stole $3.6 billion worth of crypto from, from exchange Bitfinex? I think, yeah, it was Bitfinex. This little couple right here. So I guess they came to New York and they tried to launder some of that Bitcoin over and got caught. It was these two guys who took that money and been running since, I think, 2019 or 2016, one of those. Now, her TikTok is crazy. You guys should watch it, but I'm not here to do anything like that because I don't think he's going to last in federal prison, and she's going to have to go to federal prison too. Not a good look, but I want you guys to be aware of this. When you get into the cryptocurrency space, make sure you have your own wallet. Make sure you know where your private keys are at, because these exchanges are continuously getting hit. We're just seeing a major hit on a bridge on Solano from Wormhole or Wormpool, one of them. That was the name of the bridge, and somebody infiltrated and took a lot of funds. So remember, guys, when you get your crypto, get it off the exchange, put it in your own wallet, because these exchanges, they have multiple people. They have inside jobs. They have people who have no idea what they're doing. And in some cases, some of these exchanges don't have enough money to give back to the people who have gotten their funds stolen. Be aware of that. In the cryptocurrency world, people hold their own crypto. Don't leave it on exchange. So if you enjoy content like this, visit my page on YouTube and come over here and subscribe to my channel. If you was wondering what I was drinking Hennessy Privilege, very, very fine, with the $100 crystal glass. You gotta have one of these crystal glasses. They got a little weight on it. I love the weight of this glass. Makes the drink feel a little bit better. So hit the like button, hit the subscribe button. Thank you for watching, and all you guys have a good day, and all you guys have a good night, and enjoy the crypto life. Peace.